The US Federal Reserve meets in June to discuss whether to raise interest rates again to combat high inflation. This follows a 50 basis point increase in May, which was the largest in more than 2 decades. Well, to discuss the economic impact of this, we're joined by Commercial Banking's Head of Research, Ginger Chambless. Ginger, thanks so much for joining us today.
Thank you.
So, given that we are expecting more interest rate hikes this year, how likely is it that inflation is going to come down anytime soon?
It's certainly our expectation that with the Fed raising interest rates and tightening monetary policy, that it will start to tame inflation. We're still pretty early in the hiking cycle, and it usually takes a while before higher interest rates affect behaviors in the economy. That said, we do think that we're either very near or just past peak inflation in the US. And while it could stay elevated in the near term, we'd expect to see more noticeable improvements later this year. We'd also add that supply chains have a role to play in this inflation story, as bottleneck pressures have constrained supplies of certain goods where demand has been strong. This has pushed up prices. So we think if we get the combination of higher interest rates and improvement in supply chains, that inflation should start to cool to more tolerable levels late this year.
Mm-hmm. And how will this tightening cycle affect consumers, do you think, particularly those looking at trying to pay off mortgages and credit card bills?
Well, the majority of US consumer debt is set at fixed interest rates. So we don't think that the recent hikes will have a material impact in terms of debt servicing costs over the near term. Where we do expect to see this have more of an impact would be on how consumers approach future credit dependent purchases like homes and to a lesser extent autos. In the housing market, mortgage rates have risen sharply on the year to date basis. More recently, we've seen 30-year fixed rate mortgages at 5.5%. That's up from 3% just 6 months ago. That's a very large move in a short period of time, and it's starting to impact affordability. But if we look in a longer term historical context, it's manageable and still low. In terms of revolving credit or credit card debt, this represents about 5% of overall consumer borrowings in the US. And we would expect to see the higher interest rates pass through more quickly here. But even on revolving credit card balances, these were very subdued during 2020 and 2021. We've only recently returned to 2019 levels. And if we take a look at delinquencies, these have ticked up very slightly since the end of last year, but remain near historic lows.
And on the corporate side, what do these rate hikes mean for small and medium-sized enterprises that account for a lot of the job creation in the United States?
When we talk to mid-sized businesses, I'd note two things. First, for borrowers of variable rate debt, they are doing some scenario planning to understand how the higher interest rates will impact their cash flows and also their profit margins. But probably what's getting more focus is how the higher interest rates will influence the economy, inflation, and the outlook for growth. We think if higher interest rates are successful in taming inflation without tipping the US economy into recession, that would be a welcome development for businesses, even if it does mean a modest increase to their borrowing costs over the next year.
Interesting. And are there some industries that are particularly affected by interest rate increases?
Yes. So real estate and financials, including banks and insurance companies, have historically been the sectors most sensitive to changes in interest rates. For real estate, a higher interest rate environment is generally more challenging. But what we're finding in today's environment is that real estate's natural inflation hedging attributes, including price appreciation on the underlying properties, as well as the ability to pass through higher rents, is providing some offset. In financials and banks and insurance companies, a rising and higher rate environment is generally beneficial. It typically coincides with periods where you see increased profitability.
On the theme of recession, how likely is that, given that we are seeing slowing economic growth in the United States?
So we're not predicting a recession within the next year, and our base case is for a soft landing. While there's certain aspects of the economic recovery that are in the later innings, we have a US consumer that has very strong financial health. They've accumulated excess savings at an estimated over $2 trillion. There's very low household debt to income levels. And demand continues to be very strong. We've seen continued elevated demand for goods, while demand and spending on services is increasing. That's where there's a lot of pent-up demand. I'd also say labor markets are very, very tight. They're as tight as we've seen historically, with more job openings than there are job seekers. Usually you see a softening in the labor market before a recession hits. And currently, momentum appears to be going the other way.
Certainly a situation I know you'll be watching closely. Ginger Chambless, Commercial Banking's Head of Research. Thanks so much for your insights today. Appreciate it.
Thank you.